Global oil prices have plunged sharply. Brent crude has slipped below $65 a barrel, and Russia's Urals crude is nearing the $50 mark for the first time in nearly 2 years. The rapid $10 per barrel decline in international benchmarks has triggered warnings from both Russia and Saudi Arabia. Saudi, which relies on oil for 62% of its government revenue, and Russia, which depends heavily on energy exports to fund its federal budget, now face mounting fiscal pressures. The IMF estimates Saudi Arabia needs oil above $90 to balance its budget, while Russia's oil and gas revenues in March fell 17% year on year. In Saudi Arabia, falling oil revenue is already translating into higher borrowing. Public debt surged 16% this year to $324 billion, and state oil giant Aramco's dividends are expected to drop by $32 billion, hitting both the government and its sovereign wealth fund. Similarly, in Russia, April's oil and gas revenues are expected to fall sharply, exacerbating the budget gap. Central Bank Governor Elvira warned that escalating tariffs could further hit global demand and worsen oil price volatility, threatening Russia's economic stability. Both governments are recalibrating policies to manage the fallout. Saudi Arabia is reassessing timelines for massive Vision 2030 projects like NEOM and the 2034 World Cup as it juggles spending with debt constraints. Russia, meanwhile, is closely monitoring the turbulent oil market, according to the Kremlin, and is taking steps to shield its economy. The central banks of both nations stress that the main risk lies in sustained low oil prices and continued trade tensions, which could suppress global energy demand. While both economies benefit from relatively low debt to GDP ratios, prolonged price weakness poses a serious test to their fiscal resilience and long-term plans.